Multifamily Mindset
podcast. Think bigger.
All right, aloha, y'all, and welcome to another Aloha Friday episode on the Multifamily Mindset podcast with Tyler Deveraux,
Jackson Campbell.
Jackson Campbell.
Me.
Let's dive in, man. Let's do this. What are we talking about today?
Well, before we dive in, we're going to talk about deal criteria. I'm very excited to talk about this investment criteria, deal criteria. But before we dive in, if it's your first time listening, if it's your first time joining us here on the Multifamily Mindset podcast, welcome. Very happy to have you here. We have episodes every single day. It's a very high-level podcast, putting out episodes every single day, Monday through Thursday, with Dallas Pruitt mindset, 5 to 7 minute long episodes in the morning. Get your day started off right. Definitely tune in for those. And then on Friday, joined here with Tyler Deveraux every Friday for Aloha Fridays. I get the pleasure to sit in on some of these with Tyler and interview him, but you'll also see a bunch of guests that Tyler interviews, high-level guests on those Aloha Friday interviews as well. Yes. So, but let's dive in. Investment criteria, Ty. A lot of people have been bringing it up, and it's been a question that's been coming up in the network, the Multifamily Mindset Network, a lot lately on investment criteria and how to determine what your investment criteria should be.
Okay.
So, breaking it all the way back down to the beginning with you and Ryan when you guys started doing multifamily real estate together, what did your guys' investment criteria look like right out the gate?
I love it. Well, okay, so first off, your investment criteria is important because it's going to help you get granular on what you should take down and what you should do, really what opportunities you should pursue. But in the beginning, bro, it's like you're going to chase everything in the beginning. Now, so you asked what our criteria was in the very beginning. It's like anything that we can make work.
Yeah.
You know what I mean?
Yeah.
It's like in the beginning, you're just trying to get a deal done. It's the law of the first deal. So you're trying to get that first deal done. So dude, as you're trying to get a deal done is like, so it's identifying in the beginning, chasing everything. But can I give guidance on that?
Yeah, definitely. Because that might seem a little bit chaotic. Just like running after every maybe little opportunity that pops out, that might get a little messy.
That's it.
Yeah.
And so my advice to you would be, you need to have a sponsor on a deal anyway. And for those of you who don't know, a sponsor, it's their job. It's a seasoned operator. Their job is to guarantee the loan. So they have net worth, liquidity, experience to guarantee a loan. Those individuals have a target. They have an investment criteria. Like, we are very granular with our investment criteria. Right. So even though I said we chase everything in the beginning, and then we start getting more and more deal flow, so we have to narrow our focus so that we really know what to focus on. My advice to anybody starting out is, before you really just dial in what your investment criteria is, you need to know what your strategy and those kind of things are, and we can dive into that. But you should be contacting your sponsors. What are they looking for? And then go find that.
Yeah.
Yeah.
So, to kind of encapsulate what you just said, instead of...
Encapsulate. Great word.
Thanks, dude.
God, sometimes, bro, you drop words and I'm like, great word. Not all the time. It's very rare.
I know,
but
it is pretty rare that I use big words. So to encapsulate everything you just said here is, instead of creating your own criteria of what you think it is that you're trying to chase down to buy, you should find somebody that's done it before you, see what their criteria is, and then take their deals to potentially partner with them.
Yeah, because it's the easiest way to kill two birds with one stone, because they have an investment criteria for a reason, right. And you should have a good understanding, at least a ballpark of like what your focus is. But it kills two birds with one stone, because if you know what their criteria is, and now you can go source a deal that meets that criteria, the chances of those individuals sponsoring that deal are so much higher.
Yeah.
So much higher.
Yeah.
It really comes down to three basic things, dude. Like three things.
I want to dial into those, but real quick.
Okay.
You've now moved to the other side where now you're sponsoring deals.
Yeah.
And now you're on the other side as that sponsor with your criteria, and there's new people coming to you.
Mm-hmm.
What advice would you give to those individuals that do have deals that they might want to bring to you?
Great question, dude. My advice would be this. Every sponsor likes to get the deal presented to them in a certain way. Every sponsor has little nuances. So what makes it very easy for us, you want it to make it as easy as possible for your sponsors to say yes or no. It's the same way when you present a deal to investors. Like, you want it as easy as possible for them to say, yes, this is a fit, or no, it's not. But in order for you to do that, so what I would do, I would call the sponsor. And I'd be like, okay, not only what is your investment criteria, like what are you targeting, but also how do you like the information presented to you? What does that look like? Has anybody else, like, do you want to send me an example? Because like I can send you an example right now of how we like the information presented to us.
Yeah.
I look at Gibby's, and people will be like, man, you guys have sponsored a lot of deals for, that's, Eric Chatterton and Brett Davenport, Megan Davenport. Like, why have you sponsored so many deals for them? Because they make it so simple.
Yeah.
They've asked us these questions. How do you like your deal presented to you? What is your target? What
good.
areas are you targeting? And then they follow suit.
Yeah.
That seems so simple, but man, we'll get people submit deals to us on different underwriting templates, either way too much information or not enough information.
Yeah. Yeah. And
Sometimes, dude, I'll literally swear to God have people just send me like the LoopNet link. Hey man, here's the LoopNet link. Is this the deal you're interested in? It's like, okay.
Yeah.
I don't even click the LoopNet link.
You're right.
Like, come on, man.
Yeah, it's an automatic no.
Yeah.
Dude, because a lot of the times, I think this is so good that we're highlighting this real quick, because I think a lot of times students might present a deal to a sponsor and not hear anything back. They might get ghosted. And it might be because you didn't present it the right way. It might not be because you have a bad deal. It might be a good deal.
Mm-hmm.
But you presented it to the individual the wrong way, so they didn't see that it was a good deal.
Yep.
Right, dude. I love that we touched on this really quick, because it's such a big thing in business, in real estate business, obviously, but in business altogether. It's communication, dude.
Oh, yeah.
It's really understanding who it is that you're talking to, how do they like to receive information, and getting them the information the way that they like to receive it, right?
Bullet points.
Uh-huh.
I don't want paragraphs.
Some people are bullet points. Some people do want a huge write-up.
Totally.
Some people do want a magazine full of stuff to read all this information
Yes.
about what it is. Some people do like that. Some people want a PowerPoint.
Yep.
It's very visual. They want pictures. They want all this other stuff, right, dude? So yeah, dude, it's very important to identify how to communicate with those
So
investors.
true, bro.
It's so true.
Yep.
It's so true. Anything else there that you might want to add on when presenting a deal to an investor? Maybe the follow-up. What does follow-up look like?
Well, real quick, we went through like a sales framework
Yeah.
a little while ago.
Yeah.
And that sales framework, if you listen to those episodes, we told you that it's high-level communication. That's what it is.
Huh?
High-level communication is the first step of that is switching seats. That's first step. So switch seats, meaning see it from the other person's perspective, really ask the questions to figure out how they like the cockroach.
Get him. Get him. Get him. Thank you.
We're cutting that out or keeping it?
No, we're keeping
I can't
it.
handle seeing a cockroach run across the floor. This is Maui problems.
It was coming
dude.
after me, dude. You got me. You saved
Hey,
me.
I can't let my boy be getting attacked by a cockroach mid-podcast, dude.
Thank you, sir.
Oh, man, I got a little bit of guts on my J's, though.
Oh, well, we'll clean those up. We'll get those cleaned up.
We'll buy some new ones. Guts on my J's, buy some new ones. You can wash them. Nah.
No, new. Okay, where were we here?
I don't know. Switching seats.
Switching seats.
It's
yes.
no different, man. It's that once again we call it a sales framework, but it is a high-level communication framework. Yeah, just switch seats.
Yeah. Switching seats with them will give you a very good perspective on, if you were the sponsor, how would you like this deal presented to you?
Yeah.
For sure. Awesome. Okay, so dialing in, let's say we've moved past that point of maybe meeting with sponsors and partnering up with sponsors and using their criteria as our own. But now we're kind of putting together our own criteria.
Yeah.
How do we, you mentioned you should have a high level overview of what your criteria kind of looks like before even talking to sponsors.
Totally.
So what does that high level overview look like?
So first off, it comes down to three things, man. It comes down to your investment market, just to simplify the process. Your investment market that you're targeting, your investment strategy, so value add, reposition, turnkey, and then number three is the investment, the actual property, the investment property. That could be the neighborhood it's in, the year that it's built, the size, like how many units, the grade of the property. You should have those things dialed in no matter what. You really should. Like, how did Ryan and I do it? Yeah, we targeted and we talked to sponsors on what they were looking for, but we also got trained on, like, we knew, for an example, we weren't going to go raise money for a reposition deal or a turnkey deal. Our strategy was value add strategy.
Right.
We knew that. So we targeted sponsors that was also their strategy, and then got more granular on the other things. What markets were they looking into? Anyway, you get it.
Yeah. Dude, I love it. Okay, so those are the high level three things: is your market, your strategy, and your property.
Yep.
Okay, so let's kind of break those each down individually. When we're talking about market, how do you really determine what market to go to?
This is, I would say, the biggest mistake people make when they're submitting the deals to us. They know like the strategy that we have. They know the, I guess we call it a buy box, like the details about the property, what size, what price, all those kind of things. But they'll bring us deals in whatever market they're looking into.
Right.
The reason that that's so important to identify your market first, and let's say that you're on the acquisition side, or regardless of what you're doing, you need to identify your market, because once you identify your market, you're going to build teams up within the market. Mm-hmm. That's your foundation. And now any deal you take down after building up your team is way easier. So you come to us and you bring us a deal in some random market. It's not that we can't do it. We can do it, but it's going to take us more time and effort because we now have to go build that team, especially if you haven't taken the time to build the team.
Right.
You've just sourced a deal randomly. It's going to take more time and effort. Even if you have a team, we're going to have to vet your team.
Right.
But if you've built the team, that shows me that you're committed. If you have a team and we can piggyback off that team, and it's just a matter of us vetting instead of finding, but that's super valuable.
Yeah. Yeah.
Right?
And that might be a good opportunity for us to get into a new market.
Totally.
Yeah. Yeah.
Totally. So, but it makes it so much easier for us to say yes, period, when it's in a market that we're already targeting and we're already building teams up in, we're already establishing whatever that is. So what markets you should buy in? You should buy in emerging markets. Like, this is really a whole nother episode in of itself, probably.
Yeah, we could totally.
But there's 4 stages of a market cycle. Buyers 1, buyers 2, sellers 1, sellers 2. The most ideal place to stage to buy in, and at any given point, a metro area is in one of those 4 stages. A lot of times people think that it's a country. The country's in a stage. Every metro is in different stages. So we're going to look at, the most ideal place to buy is a buyer's market 2. But you can buy in any of those stages of the market. It's just your strategy is different. So where you're going to buy, good economic growth, good fundamentals. I'm looking for job growth, household formations. Those are the 2 biggest, most important things we're looking for.
Yeah, dude, so good. You said something that sparked a question. You said generally people think of the market as the whole country, as the whole country being in the same market, right? But no, it's actually the metro is what you said, right? So what is it, in layman's terms, what does that mean, Ty?
The city.
Yeah.
Just the city area.
Getting more granular there, right? Because I hear a lot of times people be like, I ask them what market they're looking into, and they say Texas.
Yeah.
That's not a market.
No,
that's a state. Yeah. So just
now, we'll buy. So we'll buy in. It starts there. So for example, South Carolina. I see that South Carolina has this is a couple years ago, but they elect a new governor, and that governor is very pro business. And so we had already been looking at different cities within South Carolina, and we start looking at trends within these areas, right? In Columbia, we see starts to have an uptick in job growth. Well, okay, so we look at why is there an uptick in job growth, and we relate it back to the governor of South Carolina, pro-business friendly laws, very pro-business friendly, pro-business. They're friendly towards business.
Yeah.
They like when businesses come in.
Pro-business friendly, I like it.
And so that's what's caused an uptick in job growth in Columbia. And what do? We dive in full force. So you can find states that you're interested in, sure, but then you have to drill down before you truly commit to a market, then drill down into a city. So to your point, somebody that tells me that they invest in Texas is huge.
Yeah.
Houston, San Antonio, Austin, Dallas, it's
Yeah.
Those are all very different markets.
Very different markets.
Yeah.
Like the insurance rates, let alone we don't need to get in super details there, but they're just super. It's the same state, but they're very different markets.
Totally.
For sure. So getting granular there is super, super important. Anything else, or you want to add on the market?
No, I mean just that. If you were to ask what we look for, it's political, economical information that influences what we buy. So economical information, that's the job growth, household formations. Those things are key. Political information are things that would attract businesses. It's also landlord laws versus, is it landlord friendly or tenant friendly? For example, California, right?
Right.
Very, very tenant friendly.
Right.
They have, what's the word? They have, what's the word when they cap their rents? My gosh, my mind just went blank. Rent control.
Yes.
Sorry.
Yes.
when this happens, rent control.
I need to learn your sign language. That's what I need to do. I just need to learn Tyler's sign language.
You think you know it by now, bro? how long it takes to evict a tenant, what can you really operate your business? Like, how in charge of your business are you? So we invest primarily, we invest not primarily. We invest in states that are landlord friendly, safer.
Okay, dude. So that next piece that you talked about was the strategy, investment strategy. Can you dive into what your investment strategy is now that you guys are doing your own deal?
And it always has been value add multifamily real estate.
Yep.
So value add, this is a property that has some small problems that we're going to come in and we're going to fix these small problems. That'll increase the cash flow, increase the value of the property. Low rents, low occupancy, high expenses, maybe some operational inefficiencies on the property, these kind of things.
Yeah.
So if you look at it in tiers, okay, you have turnkey. That's like an A asset, high-end A asset, very little risk, which there's also lower return. There's not a ton of problems on an A asset, a turnkey A asset. It would be a great way to invest in for wealth preservation. Not necessarily wealth. For example, like returns on something like that might be 8 to 10%, something along those lines.
Not very much.
Light value add opportunities. Now you have the opportunity to benefit from cash flow and equity because you're forcing the appreciation.
Yeah.
Now, I mean, dude, now your returns would range in the 16 to 18% return annually. Then your other, like the riskiest type of multifamily deals, what's called a reposition. And that's a lot of construction. You know, you're below 85% occupancy. You have to put in, $8,000 or more per door in to renovate and take care of that. Just get the property back up to where it needs to be. That's the riskiest. Now you can make a lot of money on that, but and we've done those. But it's the riskiest type of multifamily acquisition. So at any point, never do we want the bulk of our portfolio to be repositions.
Right.
We've done them, but the bulk of your portfolio should be, with what we teach, value add multifamily. And then, you can sprinkle one or two of those. It's a lot, dude. It's a lot to manage a project like that.
Absolutely. Yeah. It is. Dude, so Ty, one of the things that like you're always saying, Ryan's always saying, everybody on the team is always saying, is how we identify as problem solvers. Mm-hmm. Right? We're all a bunch of problem solvers, and we figure these properties come in that have problems, and we identify those problems, and we solve those problems, and we take down these properties. Every property that gets sent our way has a problem one way or another. How do you, I guess what I'm trying to ask here is, how do you determine what problems you want to address and what problems you don't want to address?
Yeah, great question.
Right, because like we think we can accomplish any problem, take care of any problem, solve it. So like how do you determine what problems to solve?
Well, the ones that have the best returns. So problems are neither good nor bad, they just are. They just are. I believe what determines a good problem on these properties, a good problem versus a bad problem. Actually, dude, this is in business, not just these properties, this is period. Business, I have a shit ton of problems. There's a lot of problems that filter across my desk. Which ones should I be putting my time and effort into? The ones that are going to actually produce the return that we're looking for. Way too often we get caught up in solving problems that provide no return. Those are problems that should be pushed aside.
Yeah, put on the back burner. Waited.
Not even on the back burner. Off the fucking burner.
Just done. Get
off
here.
my goddamn stuff.
Yeah.
Like, if this problem is going to provide no positive result, then dude, I'm not wasting my time.
It's almost not a problem at that point. It's a nuisance. It's like it's like it's not even
somebody else's fucking problem.
Exactly. Exactly.
So that, man, I look at here's my like, I guess, strategy. Problem comes. Okay, cool. That's the problem. What's causing the problem? Can we solve it? And if so, like, what's the solution, right? And if we solve it, what will the return be? If the return makes sense, if it outweighs anything, then dude, let's go.
Yeah.
Because listen, problems, you say we're problem solvers. We get paid to solve problems, and that's a lucrative business to solve problems. That's literally what business owners are. And as a property owners, we are problem solvers. And we're business owners. These properties are businesses. So what are the problems? Can we solve them? And then which ones should we attack in our business plan that are going to make the most sense? And by most sense, I mean bring the most return.
Right.
Those are the ones we target. Those are the ones we solve. there's always tons of problems. But once again, which ones are going to provide the returns and which ones do you need to ignore?
Yeah.
Because you can't solve every problem. That's not even a real thing. You only have so much energy. You only have so much focus. And if you have diluted focus, you'll get diluted results.
Okay, got it.
Right.
Dude, so good.
That's a Rory Vaden quote, I'm pretty sure, dude.
It's
Diluted focus produces diluted results. And it's so true, though.
So true. So, Tyler, has there ever been times where you guys have gotten a deal where you're like, this isn't in our investment criteria, but we know we can solve these problems? Do you continue down the path of taking down that deal, or do you stick to your criteria and throw it out the window?
I'm an addict, bro.
What do you mean?
Meaning it's hard when a good deal comes across your desk. So let's, for example, right? We talk about the property. So think about what we've talked about. We've talked about the market. What markets am I looking for? I'm looking at ones that are landlord friendly, that are in either a buyer's market 2 or a seller's market 1. Those are the most ideal stages, in my opinion, to buy. In specific areas of the country, like we like Sun Belt areas. Okay, that's the market. Then we look at the criteria. We're looking at value add opportunities, light value add, $3,000 to $8,000 a door, maybe 85 to 90% occupancy, B plus or C plus property to B property in a B area, 3,000 to 8,000 a door. I can't remember if I said that, but those are our targets. Okay. Also, year wise, size wise, we like 100 plus units, and then year built, we like 90s or newer. Okay, so that's a good idea of what our target is. But let's say that somebody brings us a deal that, I don't know, maybe it's a little bit smaller than 100 units. Or maybe it is not 90s or newer, maybe it's in the 80s. Or, dude, we're kind of addicts sometimes because we look at it, it's like, okay, that might not fit specifically.
Yep.
But that's a good freaking deal.
Yeah.
And some of those deals are like Cedars, 40-unit property. We didn't want to do that property. We really didn't. And that was even in the beginning stages.
Yeah.
It was just smaller than what we really wanted to do. But we saw the value of. We saw the potential of.
It was a great deal.
Windridge, 46 units. It's like, so what was your question?
If you take down these deals that maybe aren't right within your criteria.
Okay.
Yeah.
Where did we?
No, it's good though. I loved your answer. I loved what you said here because really what I got out of that was, yeah, we'll do deals that are outside of our criteria, but it needs to be presented to us in the right way, which is the first thing we talked about.
And it needs to make sense.
It needs to make sense. And
like
it needs
there needs to be something some positive, some pro that outweighs the con of it not fitting exactly.
Exactly.
But, yeah.
But that's good. That's good for everybody listening that maybe wants to do a deal with Tyler that maybe doesn't have the exact deal that fits Tyler's criteria. Tyler just told you how maybe he would still be able to do that deal if you were paying attention.
Dude, and it's like when you catch us too, right? It's like, dude,
yeah.
Like dating compared to dating. You have this like idea in your mind of who this 10 is that you're looking for. I mean, you might get towards the end of the night, bro. Slim pickings, you might settle for a 7.
It might. You might.
I've never settled for a 7.
Yeah, I don't know what that feels like.
A lot of you out there have settled for a lot less than 7s. You guys are fucking around with 4s and shit.
Get it together.
Get it together. But it's like you might maybe our deal flow is dried up a little bit.
Yeah.
And all of a sudden you bring us a deal that once again is a little bit outside of the criteria, but it makes sense. Well, you caught us at a great time.
Yeah. Yep.
That's great.
Yep. It's good. It's good to know if you're listening for sure. Tyler, okay, what else here, dude? We went over the market, the strategy. What about the property? Let's talk about the property a little bit.
So when I look at the property, I look at year build. I told you we like to target 90s or newer, and that hasn't always been the case. I mean, honestly, 2000s or newer is like ideal, but that hasn't always been the case. Dude, in the very beginning, we didn't even look at year. I didn't care.
Yeah.
I didn't.
Yeah.
But the more you get into it, the more you realize that the older it is, the more maintenance needs to be done, the more work needs to be done, the more problems that can come up.
Yep.
And once again, problems can be good. Those can be solvable, like we just talked
Profitable.
about. Yeah. But we like to be more strategic. Number of units, it's like it takes just as much time and effort to do a 150-unit deal, 200-unit deal, 300-unit deal. Dude, as it does to do a 40-unit deal, a 20-unit deal. Same effort, dude. In fact, sometimes those smaller deals can even be more effort.
Yeah.
So
So
we're looking at the size. We're looking at the year built. We're looking at the neighborhood. That's another thing. Neighborhood's so important because what you can't change is location. You can change a lot about the property.
Yeah.
You can change and enhance the interior. You can change the exterior and enhance the exterior. You can't change the location. So what is the neighborhood like? What's the surrounding areas like? And what's the trend? Is it in a path of progress? Is the area, attracting a lot of investment capital? Are there a lot of properties in the area changing, improving? That's what we ran into with Columbia. We bought in areas that hadn't necessarily always been the best areas, but the areas were changing. The growth was moving in that area, and that was obviously indicative of what the returns we saw on those assets were.
Indicative, nice word.
Thank you. I felt good to say that too. Indicative. So, unit mix we look at. Mm-hmm. We prefer more 2 and 3 bedroom units than 1 bedrooms. They're easier to rent during a downturn. Usually more qualified tenant. They stay longer. It enhances your renting, increases your renting pool. A single person can rent a 2 to 3 bedroom, but a family can't rent a 1 bedroom. So we're looking at the exterior of the property. Is it brick? Is it vinyl? Like, what's the skin of the property? We're looking at the roof. Is it pitched? Is it flat? Your lending options would be different there. So it's like there's lots on the property that we look at. The most important things that we look at, though, location, because you can't change it, and then what's our business plan going in? Like, what can we do? How do we compare it in the market? Where are our rents sit?
Yeah, and does that business plan match the location?
Yeah,
and how that location's trending, right? Do those
say that again?
You got to make sure that the business plan matches the location.
Yes,
matches the market. How that market's moving. Is your business plan going to move with the market there?
Is it actually going to make sense in that market that you're investing into, in that city, in that neighborhood? Does that make sense?
Yeah.
I look at Orlando Sky, dude.
Yeah.
You go to Orlando Sky. We tell you that if you lived in Orlando, we told you where it was. And we've done this. Like, I just taught a class in Orlando.
Yeah.
We talked about where it was, and most people are like, I wouldn't buy there. I wouldn't buy there because they don't know. They just know what they know, but they don't know the dirty details.
They know the history, dude.
Yeah, that's it.
They know the history. They don't know where the market's trending in that area. That's where we're experts at, right? That's what we're really good at, is determining those markets, figuring out where those markets are trending.
Trends, yeah. That's so true, bro. The trends of what's happening within the market and what investor capital has come in and what city capital has come in and all that kind of stuff.
Oh, I'm glad you point that out because it's important for even new investors going into these markets. Maybe those local people that have lived there for a long time might not be the best people to talk to about the property because they just have history. You know what I mean? They have all these bad experiences. They might have some good ones, but the bad ones are going to stick out for them more, for sure, especially if they're buyers, right? So I don't know. It's a good takeaway. It's a good takeaway. Do your own proper market research. Don't just listen to the people in the area tell you about this property.
Totally. Remove bias.
Yes.
Remove bias, do the research, and you make the decisions based on the research. You have a little gut, you get a little gut feeling.
Sure.
That comes in.
Intuition for sure.
But do the research and allow yourself to be open for the gut inspiration.
There you go. Dude, because you can't receive that inspiration unless you do that work up front. You can't, dude.
You put the work in to be worthy of the inspiration.
Absolutely. Could not agree more.
That's it. So then, but I look at Orlando Sky. Dude, Orlando Sky is, and if you were to even just drive by it, there's nothing sexy. Like, there's nothing like truly sexy. Like, it's a C asset, But that property performs like clockwork.
Yeah.
It's a great property.
Yeah.
So it's like, you need to know what you're looking at far past just the optics. The optics are important once you take over. If you can improve the optics, even better. But what is the business? What is the business currently at, and what business plan can you operate, and how will that drive the value of the business? To make a business decision, not an emotional decision.
Dude, right? So good. So a great takeaway. When putting together your investment criteria, it needs to be a logical business decision.
Yeah.
Not like an emotional type decision when putting together your criteria.
And dude, I have, because it's very easy sometimes to, especially in the beginning, like I said, you're chasing, right?
Yeah.
You're just trying to find a deal that works, to only cherry pick the good information and be blind to the bad. And I know that happens. Once again, can't do that. Or you can, but and that might make you happy in the short term. That's going to bite you in the long run. It just will. And that's hard for people because we're so many people are so short-term focused because the need is in the short term. But if you can see the long-term bigger picture, and listen, there's a gray area there too. Like if it was up to Ryan, we would have never bought any property.
Right.
You know?
Right.
And if it was up to me, we would have bought properties we should have never bought.
Sure.
I'm an ultimate optimist, and he's way more conservative. We balance each other out, and we have these conversations. Then we move forward based on, dude, what makes sense.
Yeah.
What we're willing to accept there.
Dude, so good. Ty, so many gems from this episode, and so many good takeaways from this. But if you had, I guess, what's the last little bit of advice you could give to somebody that's just starting out into the multifamily realm, multifamily market? And they're stressed about this. They're stressed about putting together their deal criteria. What would you say to those individuals?
Ask questions. Ask tons of questions. Ask questions and understand why your deal got turned down. Understand if you submit an offer on a property and it gets no counter offer or shut down. Ask why. How could you be more competitive the next time? If you submit a deal to a sponsor and they don't reply, how could I present this better the next time? What can I do? It is right before we started recording, man. I got a message from somebody, and I had just sent an audio. They asked a question. I sent them an audio recording of like a voice recording, whatever, of like, hey man, this is what I would do. This is my advice. And then they replied back right before we started, and just I guess talked about how they just initiated or put the advice that we gave to work. Ryan was on that same thread. And what I was about to say before we started that I didn't even say was, man, I freaking love to. I love pouring into people that actually take action. I love pouring into people who want to be, who are actually coachable.
Yeah.
Right? It's like sometimes when you're in that position where you're needing help, sometimes you feel like you're a burden. But in reality, you're only a burden if you ask for help and don't apply the help.
Sure.
Or don't apply the advice.
Right.
So my advice would be, dude, ask questions. Understand why certain people think certain ways. And not just one. You shouldn't just ask us. No. You should ask, dude, get a viewpoint from multiple different people, because every person's going to look at something a little different. And then that will inform how now you operate and how you look at things. It will. Like I remember Dave, Dave, when, we would ask him questions, and he told us, like, all these properties in Charlotte that we freaking cleaned house on, he told us to pass on all of them because of the stage of the market that we were in. Now, Dave, but you have to understand, Dave's at a different stage of the journey.
Sure.
Dave is super conservative at the stage that he's in, so he was giving us advice based on the stage that he was in. Period.
Yeah.
We were more aggressive in that stage of the journey, and now I would say we're more conservative. Not even more conservative, way more pinpoint.
Yeah.
Way more tactical.
Clear. Yeah.
Yeah. So once again, get advice from multiple areas and make the decision that's best for you, but get advice, listen to it, understand what they're trying to tell you. If you do that, dude, you'll learn a ton of actually why we think how we think and why we do what we do.
So good.
And that is really what you're looking to do.
Right.
That.
Yeah. Learn.
Yes.
Listen, learn, act, put it to action, and grow.
That's it.
Dude, and again, continue to improve. Ty, great episode, man. There's a lot of really good information in this one, so I appreciate you sharing all this information, brother. Anything you want to say here as we close out? Obviously, we've got our Hawaiian value that we'll get into too.
The other thing that I would say that we didn't mention that is just the last bit of advice is your price that you're meaning. And when I say price, it's less about what you're paying. Returns come into play too. Okay, that comes into play with your value add and what returns you're targeting and what investors you're working with. So those definitely come into play. But then also your price, because your price is going to dictate how much you can qualify for on the loan and how much you can raise, how much you need to raise. So you need to have a sponsor in place that can qualify for the deal that you're bringing, like the target that you're bringing, the deal, the actual loan amount that will be on that deal. And then you need to have the ability to raise the capital for that, or you need to have a team member, somebody that that you can partner with and outsource to raise X amount. So if you're trying to bring a deal that's a 600 unit deal and you've never raised a dime of capital, well, listen, that could be possible if you're partnering with somebody that they for sure know that they're going to tackle the raise.
Yeah.
But if not, you shouldn't be targeting that. You should really be targeting something smaller, that you know you can take down, that you know you can get to the closing table, that you know you can get done.
Yeah.
Because once you get it done, now that is a testament to the sponsors, to your brokers, to your investors, to everybody that you
To
can
yourself.
perform. To yourself even more.
Yep.
That's the biggest thing, right?
Yeah.
So when you get granular, when you get specific on what you're targeting, it makes decision making easier. It makes decision making easier. You're trying to target all these different markets and people are sending you deals from all these different markets, dude. You'll have decision fatigue.
Definitely.
It's the same with your goals. Goal setting is such a powerful process because it is literally the framework to how business operates. It's like, I want to accomplish this. This is the target. And then I reverse engineer back to what it is. So think about it. The returns I want to target, I want 16% plus return at least to my investors. So now I reverse engineer. What does that metro area look like? What is the size of that property? What is the price of that property? What are the value add opportunities? I reverse engineer it, and now it makes my decision making process easier. Something comes in that hits that, cool. Let's explore. Something comes across your desk that doesn't hit that, next.
Yeah.
You don't have to waste time it's next.
Yep.
That's powerful.
I think people underestimate how powerful that is. Being able to have essentially the decision already made for you, so you don't have to make that decision. You don't have to spend the time making that decision, is so powerful. I've seen it work with us and how we've grown, and like the amount of things that you've taken on and the amount of things that Ryan have taken on. Dude, having this criteria dialed in and really clear makes it so powerful. And it really, what it does, dude, is it allows you to scale faster too.
Yeah.
It allows you to say yes and no faster.
Can I tell you what I wish I would have realized in the beginning?
Yes.
I wish I would have realized that all these things that take me a long time to make a decision on, that are hard to make a decision on, if I can create a system, a process, if you will, a guardrail on how I make that decision in the beginning. Okay, so a deal, these are my guardrails on the deal. It has to be this, and this. That helps me make the decision. People will bring us partnership opportunities all the time. It's like, should we, shouldn't we? So we have to develop a system, a guardrail on it has to hit these boxes in order for us to entertain it. If it doesn't hit these boxes, then it's not. If you start to do that in the very beginning, a partner that I'm going to partner with, like literally like an operational partner, okay, they have to hit these boxes in order for me to entertain it. Check these boxes. If you start creating those systems and processes in the beginning, you start to create this machine that now you're not operating out of like this emotion. You're not operating out of this guessing. You have created these systems from the beginning. That's what takes a business and allows it to first off build, then grow, and then be in a position to scale. But what happens is if you do this without creating those things, you build a business that then is in a position that is growing, but you don't have the scalability because you now need to backtrack and build all these systems.
Yeah.
So if you start doing that in the beginning, I'm telling you, this is like I've learned the hard way. Mm-hmm. I wish Jackson's shaking his head like, yeah, I've been part of the hard way. Yes or no, though?
Yeah, dude, for sure.
And it's like, but you know what?
Yeah.
I learned.
Yeah.
And I would rather learn the hard way than
100%.
No way. And I know you.
Oh yeah,
for
100%,
sure.
Yeah.
But it's like, if I can impart any amount of wisdom, it's like those things, those challenges that you're seeing, those challenges don't go away. Those challenges only get bigger.
Yeah.
So if you can create systems, guardrails in the beginning, it'll put you in a position to scale.
Dude, so good. So good. Do you think that's what Jay-Z meant when he said, I'm a businessman, not a businessman?
I'm not a business. I'm a businessman.
Yeah, that's what it is.
I'm not a businessman. I'm a businessman.
That's what it is. But that's probably what he meant, right? It's because he had all those decisions and those systems already dialed in to make those decisions, and it makes it so much easier, dude.
So much easier.
So much easier. Tyler, thank you, bro. Let's move on to the Hawaiian value here as we wrap up today. Go ahead. I don't know how to say this one.
I'm going to do Kuleana, though.
Okay, switch it up. I like it.
So this is another one. This is a Ho'o Kuleana, but Kuleana means... So Ho'o Kuleana, it says it's responsibility, but I know that Kuleana is take responsibility. And think about what we just talked about, and think about the word responsibility. It's your ability to respond. If you break down that word, it's your ability to respond. And taking ownership of the direction that you're going. Well, you dialing in what your target is enhances your ability to respond. We've done like multiple Maui meetings as of late about this. Enhancing your ability to respond. And you do that by getting clear on what it is you're looking to accomplish, the guardrails that we just talked about, that enhances your ability to respond and jump on something in the moment. When somebody brings you an opportunity, it's not like, man, am I making an emotional decision? No. You've already set these guardrails. You've already put things in place so you can, once again, take responsibility, enhance your ability to respond. So Kuleana, take responsibility.
So good. Yeah. I don't have anything to add. That's, beautiful.
Hey, y'all, go your actionables. Go identify your investment criteria. Remember the 3 things we talked about, okay? Your investment market, your investment strategy, and then the investment investment property. Dial those in. Get granular with those things. Reach out to your sponsors. See what they're targeting. And then go find those same things. Bring it to them and make your life easier. And then along that process, make sure to share this episode. Make sure to leave a comment, some sort of review. And then also make sure to live always with Aloha. Peace.
Multifamily mindset. Podcast. Think bigger.